Today, we're talking about two of Asia's most important investment markets, China and Vietnam. Both have strong growth potential, but the opportunities, risks, and even how you can access these markets as a retail investor are very different. In this video, we'll explain the differences between these two markets, important things you should be aware of, and how you could access them as a retail investor interested in getting in on Asia's growth. China needs no introduction. China is the world's second largest economy with decades of industrial growth, a massive domestic market, and leadership in sectors like advanced manufacturing, green energy, and technology. But in recent years, growth has been slowing. It came in at just 5.2% in the second quarter of 2025, and there are considerable headwinds to be concerned about. The property sector is still under pressure, geopolitical tensions with the West are high, and regulatory crackdowns have hit industries like tech and education significantly. Vietnam, on the other hand, is a different story. It is still considered a frontier market, but it is moving fast. The country's GDP grew 7.5% in the first half of 2025, the fastest pace in the region. The country has a young population, a rapidly expanding middle class, and is urbanizing very quickly. On top of that, the country is also pushing through market liberalization reforms and actively courting foreign investment. One of the biggest differences is how easy it is to directly invest in each of these markets. In Vietnam, both residents and non residents can open a brokerage account, get a trading code, and buy shares directly on the Ho Chi Minh and Hanoi exchanges, often without even needing to be in the country. Some sectors have foreign ownership limitations, but reforms have made account opening faster and removed pre funding requirements. China is far more restrictive. Most foreign retail investors cannot open a mainland brokerage account unless they have a specific type of long term residency permit for mainland China. Instead, access usually comes through ETFs or mutual funds. Vietnam's ETF market is small but growing. Key funds include VNM and VNAM, which target sectors like banking, real estate, and consumer goods. They can face issues like tracking errors and liquidity limits, but they're straightforward entry points for investors abroad. China's ETF market is massive and diverse. You've got broad funds like FXI, MCHI, and ASHR, plus thematic ETFs like KWEB for internet companies and sector funds for clean energy and electric vehicles. Fees have dropped sharply, and the choice is huge. However, volatility and policy risk remain high. For people interested in startup investing, Vietnam is relatively open. Foreign investors can deal directly with founders, often at lower capital entry points, and the government actively supports ecosystems through grants and innovation programs. China's startup scene is enormous but dominated by large venture capital funds and tight knit angel networks. Access often depends on deep local connections, and failure rate is high, with only a small percentage of investments succeeding in the long term. So, which is better? It largely comes down to your risk tolerance, access, and investment style. Vietnam offers high growth, easier market entry, and a young and dynamic economy. China offers unmatched scale, depth, and sector variety, but with more restrictions and greater political risk. For many investors, the smart move might be to use both. Vietnam as a high growth frontier bet and China as a strategic long term play, approach with patience and diversification. If you found this video informative, please check out Vina Edge for more information about emerging market investing and living. This video is for informational purposes only and is not intended as investment advice. Please consult with a certified financial advisor for any investment decisions.